At 8:30 in the morning, millions of people are already moving. Trains dive underground, ferries cut through gray water, elevators climb faster than your thoughts, and somewhere behind glassed hours, billions of dollars change hands in seconds. This is New York City, and here's the uncomfortable truth. This city didn't get rich because it saves money. It got rich because it spends, borrows, and moves money faster than almost anywhere on Earth. That matters right now, because in a world obsessed with cutting costs and living within means, New York is doing the opposite, and somehow it still wins. So the real question isn't just how New York got rich, it's why breaking the rules worked. Go back a few hundred years, before the skyscrapers, before the stock exchanges. Back when this place was just a small trading post, the location looked almost boring, a natural harbor, a river system reaching deep into the continent, cold winters, muddy streets. But geography doesn't need to be exciting. It needs to be useful. The Hudson River turned New York into a gateway. Goods could come in from Europe, move inland, and come back out again, cheaply, efficiently. Then came a quiet but critical decision. In 1825, the Erie Canal opened. Suddenly, the cost of moving goods from the American Midwest to the Atlantic Ocean dropped dramatically. What used to take weeks and huge expense became faster and cheaper, and all of that traffic funneled through one place, New York. Grain, timber, fur, later, steel and oil. Everything passed through this growing hub, and with goods came money. But here's where things start to shift. New York didn't just move products, it started moving risk. In the late 1700s, a group of traders signed something simple under a tree on Wall Street, an agreement to trade securities with each other. That informal deal would eventually become the New York Stock Exchange. At first, it was small, messy, unregulated, but it introduced a powerful idea. Instead of one person funding a business, many people could share the risk and the reward. That changes everything. Because once you can spread risk, you can take bigger bets. Railroads, factories, infrastructure. Entire industries were built on this idea, and New York became the place where those bets were made. By the early 20th century, Wall Street wasn't just a street, it was a machine. Money flowed in from across the country, and increasingly from around the world. Banks grew larger, deals grew riskier, the pace accelerated. Then came 1929. The stock market crashed, hard fortunes disappeared overnight. Panic spread. The system that made New York rich suddenly looked fragile. And for a moment it was. But here's the strange part. The crash didn't kill New York's financial power. It refined it. Regulations were introduced. Systems improved. Trust, slowly, was rebuilt. And when trust returns to a financial system, money follows, always. Fast forward a few decades. After World War II, the United States emerged as the dominant global economy, and New York was sitting at its financial center. The dollar became the world's reserve currency. International companies needed access to capital. Governments needed loans, investors needed markets, and once again, the flows all pointed back to New York. But the city didn't just rely on finance. It diversified: media, advertising, fashion, real estate. Each industry layered on top of the other, creating a dense, interconnected economy. Take Manhattan, a tiny island, limited space, high demand. Basic economics says when demand rises and supply is fixed, prices go up. Sold and became incredibly valuable. Skyscrapers weren't just about ambition, they were about math. If land is expensive, you build upward to maximize its value, and suddenly the skyline itself becomes a financial strategy. But here's where the story gets uncomfortable again. New York's wealth isn't evenly distributed, not even close. A small percentage of people and institutions control a massive portion of the city's wealth. Luxury apartments sit half-empty as investment assets. Meanwhile, millions struggle with rising costs. This isn't a bug in the system. It's part of how the system works, because New York isn't designed to be fair. It's designed to be efficient at attracting capital. And capital doesn't care about fairness. It cares about return. If investors believe they can make money here, they will keep coming, even if the cost of living rises. Even if inequality grows, even if the system looks unstable from the outside, and for decades that belief has held. But there's another layer. Speed. Money in New York doesn't just exist. It moves. Traders execute deals in milliseconds. Firms relocate billions with a few clicks. Real estate transactions happen at scales that feel abstract. This velocity creates opportunity, but it also creates fragility, because when money moves fast in, it can move fast out. We saw glimpses of this in 2008. The global financial crisis hit New York at its core. Banks collapsed, markets froze, confidence evaporated. For a moment, it looked like the system might break again, but it didn't. Why? Because the same thing that makes New York risky also makes it resilient. Scale. The network is too large, too interconnected, too essential to simply disappear. Governments intervened, institutions adapted, and once again the flow of money resumed. There's a pattern here. Crisis, adjustment, growth, over and over. And each time the stakes get higher. Now zoom out. Today, New York isn't just competing with other American cities. It's competing globally. London, Hong Kong, Singapore, each trying to capture the same flows of capital. And the competition is intense. Lower taxes, faster regulations, new technologies. Some argue that New York is losing its edge, that remote work will hollow out office spaces, that companies will move to cheaper locations, that the cost of living will push talent away, and there's truth in that. But there's also inertia. A system this large doesn't shift overnight, because New York's real advantage isn't just infrastructure or location. It's concentration, talent, capital, information, and opportunity all packed into one place. That density creates something difficult to replicate, a kind of economic gravity. People come here, not just for jobs, but for access to networks, deals, ideas. And once they're here, they tend to stay, at least for a while. But gravity has limits. If costs rise too high, if inequality becomes too extreme, if the system starts to feel closed instead of open, the flow can slow. And if it slows long enough, it can change direction. There's also a deeper irony. New York's wealth is built on constant motion, but the physical city itself is constrained. A finite island, aging infrastructure, rising climate risks. Sea levels are increasing. Storms are getting stronger, and some of the most valuable real estate in the world sits just a few feet above the water. So the same place that mastered financial risk now faces very real, physical risk, and that risk doesn't move at the speed of money. It moves slowly until it doesn't. So here we are, a city that became rich by breaking conventional rules, by embracing risk instead of avoiding it, by building systems that prioritize speed, scale, and capital over stability and fairness. And for a long time it worked, spectacularly. But the math hasn't disappeared, it's just been delayed. Because eventually every system has to answer the same question. Not how fast it can grow, but how long it can sustain itself, and in a place like New York, where everything is amplified. That question becomes impossible to ignore. So the next time you see those towers or hear about another billion-dollar deal, remember this: the wealth of New York City isn't just built on success, it's built on a series of calculated risks that haven't fully played out yet, and the outcome? Still unwritten.